Joining us right now is Noah Blackstein. He's senior portfolio manager at Dynamic Funds. And Noah, what do you think of this? Earnings have been quite a bit better than expected. It doesn't always lead to the gains you might have traditionally expected in the stock.
Well, I think that we've November 9th, I guess, was around November 9th was the approval of the Pfizer BioNTech vaccine, followed by the Moderna one. And that really triggered a rally, especially in the reopening stocks. And many of those stocks have gone well beyond even where they were in 2019. So there have been a lot of expectations behind a lot of these reopening stocks, behind a lot of this normalization. And I think the good thing about this earnings season is that we're certainly seeing things getting back to normal in terms of what we're seeing from some of the banks and some of the medical companies as well. Life is beginning to return to normal. And I think that's important. But there are a whole group of stocks which, what I would call the junk rallies, it's in the first quarter, really, which are more than discounting a lot of this. So the question is, when do a lot of those stocks get back to earning what they were earning even in 19? And that's going to take a little bit more time, probably 2022, 2023, for some of these reopening names just to earn what they earned in 19. But normalization is the key, and that's a positive longer term.
Yeah, I guess I keep going round and round trying to figure out valuations. And we've always known that interest rates are gravity on stock prices, but that's something Buffett has talked about. If interest rates stay low, I guess, how do you then figure out valuations for what's fair value? You still kind of don't put that into the equation, or you do? Where do you put your money?
Well, for me, I'm always trying to figure out what the present value of that future growth is worth, and looking more at some of the secular growth names. Many of those names have really gone sideways for the last 6 or 7 months, while kind of investors have piled into this reopening trade. And I think that now that so much of the value or the low quality names have had such massive moves, I think the opportunity for investors is, you had a 90% move in interest rates in the first quarter. I think interest rates will drift higher over time, but it looks very similar to the fourth quarter of 2016 with that 70% move in 10-year yields. And then, yields probably chop sideways, head toward 2% over time. But now as we're normalizing, and I do believe we're normalizing, I think in the last segment, there was a lot of criticism of capitalism and companies. The fact that we had a vaccine approved in November and nearly half of America has received one dose, half the UK has received one dose, half of Israel 2 doses. In each of those countries, you're seeing things normalize, which is a testament to the innovation and the unbelievable power of the supply chain to get those vaccines in people's arms, and people should be celebrating these companies. We're seeing that. Yeah. The question is, how much is discounted in these stocks? And once we reach our cruising altitude, what is that cruising altitude? Are we back to where we were in 2019, or we're some level lower? There is a lot of slack. The year-over-year comparisons have probably peaked now. And the question is, some of those restaurants that closed aren't going to reopen. Those planes are going to take time to get full. When does business travel resume? So I think, the peak year-over-year comparisons have probably passed us now. And now I think you need to look at relative valuation and relative to the growth opportunity in the companies.
I think most sectors are trading above where they were a year ago. So we've already assumed that we're back to normal growth and then beyond that. So if you're looking at the growth stocks as a place where, okay, you can make more of an argument for the valuations there, is this something that you embrace? Or as an investor, do you kind of hold your nose and say, this is the one that I feel most comfortable with because I have to find somewhere to put my money?
Well, you hear a lot of people talking about technology, but really what's outperformed, whether it's been GameStops or the Viacoms or a lot of the value-oriented areas have been the areas or cruise lines, airlines that have gone sort of parabolic in this period of time, whereas those stocks have gone sideways. So I think the valuation story is normalized. But now for the value names, you got to look out to 22, 23. So you're assuming duration risk now in value. And the other thing that you're assuming, obviously, is that those stocks have such huge price momentum in some of those cyclical areas and reopening areas that you're now a momentum and duration investor in value. And so, I think as we sort of pass the peak year-over-year growth numbers, and a lot of these large growth stocks or companies with 15, 20% plus growth rates grew throughout the pandemic, I think given their sideways move over the last 7 to 9 months, I think cyclical investors would be better off moving over to those areas of the market for the next couple of years, actually, at least. There's just too much discounted in the reopening and cyclical trade as far as I'm concerned.
Shepard Smith here. Thanks for watching CNBC on YouTube.